Welcome back, traders and investors. Another special guest here on Pre-Market Prep. We have Brendon Marks, a marketing spokesperson for Hodges Capital Management, a big company managing $2 billion. Brendon, how you doing today?
I'm doing great. Thanks for having me on.
No, our pleasure. So, before we get into all the good questions here, you just give us a brief education and market background.
Yeah, sure. So I went to SMU, and I work with advisors currently with trying to help them add value to their clients in the small and mid-cap space. And so Hodges Capital has been around since '89. We're really equity specialists. We're a boutique money manager out of Dallas, but we manage about $2 billion in assets, and we're really focused on the small and mid-cap space. And we're really company obsessed. So we're looking at company after company after company, trying to find those names that are mispriced or misunderstood in the marketplace. And we're really doing that by talking to management, verifying what they say with their vendors, their customers, their suppliers, and then really trying to do the basic bottom-up blocking and tackling and just do more of it than everybody else.
Brendon, what do you think about
Yeah.
Michael Lewis's comments there? He was coming out obviously on 60 Minutes, said the market is rigged. You're obviously managing $2 billion, specializing in small and mid-cap companies. How does it feel when you're trading these companies out here? Like, do you feel like the market is rigged? Do you feel like you have issues with execution?
I don't know if rigged is the right word. That seems like a strong word, but the market is definitely fleeced. These guys are making pennies off retail trades, and the dark pools are definitely a little bit scary. But on the whole, high frequency trading is great for Benzinga listeners, and it's great for people like Hodges Capital Management because it adds unnecessary volatility to the market. We've read that 70% of all trades in high frequency, 70% of all trades total are made by a computer, and so that's a trade that's made without making any investment decision. It's to fill some sort of box, or it's done by an algorithm. And if we have that unnecessary volatility, there's going to be mispricing, and we can take advantage of that.
Well, I guess the greatest example of that was May 6, 2010, when everything was crashing down to, when you had 300 stocks trade down to a penny. Were you guys out there trading and trying to take advantage of it that day?
We really didn't know what the hell happened.
I think everybody was sitting back shell-shocked.
Hey, Brendon, can you
Oh,
boost your volume? I'm sorry, Brendon. Can you boost your volume up just a little bit?
Yeah, sure.
Okay.
Can you hear me better now?
Yeah. Yep. Much better.
So just going with
Sorry
that
about
thought, what'd you think there on the flash crash of 2010?
Yeah, we really, like I said, we didn't really know what was going on, and so I think the flash crash it's a product of those high frequency trading algorithms, and it would have been great to go buy those at the bottom, but we just weren't really equipped to take advantage of it.
Okay, so let's talk about the proliferation of ETFs, and they do create inefficiency in the markets. What ones are you most active in, and how can traders take advantage of the inefficiencies?
Sure. So we love the ETF market. We really think that because of the ETF market and the proliferation of ETFs that you alluded to, that it's really the golden age of active management, and it's the golden age for sure of active management in the small and mid-cap space. And let me give you an example. There's a financial ETF. The ticker is IYF. It's got about 267 financial firms in it. I bet you out of the 267 names, probably 30 of them are just crap. They're not worth investing in. They're probably poorly run. They're over leveraged. They're just not worth even taking a look at. I bet 200 of those names are probably market performers, or they're probably not going to do any better than the average financial firm. And then there's probably 30 of those names that are probably great buys. They're expanding their net interest margin. They're conservatively run and probably worth taking a look at. And we've seen that 90% of these names are correlated. And so if statistically 90% of these names are correlated, at some point they're either overbought or oversold. And we think that we can take advantage of buying the best names when they're oversold.
So are you using technical indicators to pick up those buys and sells, or you just do you have fundamentals that you wait for and you let the technicals kind of just time your moves in and out?
Yeah, so we don't do a lot of technical trading. We're really our approach is fairly simple and fundamental. We're looking for companies that have low PE multiples, that are growing their cash flow, and have some sort of downside protection. So maybe that's a high replacement cost. They're in a high barrier to entry type of business, or they have intangible assets that make their business have some sort of floor. And so once you're going to find these names in areas, like I said, that have high barriers to entry and in industries that have consolidated considerably. And so we're really just doing, like I said earlier, the blocking and tackling, trying to look at as many companies as possible. And then when you see the 90% correlation in your favor and the market's oversold, we think we can find ideas that are cheap and worth buying.
Okay, so let's talk about some of your top holdings, why you got into them, and where you're at on them.
Sure. Okay, so in the early 2000s, the railroad business was probably the worst business over the past 30 years to invest in. They never earned their cost of capital. It was just a bad business to be in. And over the years, the industry consolidated considerably. Pricing power returned, and we really liked Burlington Northern and did really well in that, obviously, when Warren Buffett bought it out. But we see a lot of similarities in a couple industries now. The most significant one is the airline business. We've all heard the jokes that nobody's made money in the airline business since the Wright brothers, that if you want to become a millionaire, start as a billionaire and buy an airline. We've heard all the jokes. And so the business has been, or the industry has been significantly underowned. And we saw a couple of years ago that while it had been one of the worst industries to invest in, airlines had gone broke right and left, and it really the management teams had the perfect picture of what not to do. And so as the industry consolidated, pricing power returned, the management team started cutting back on flights, the price wars were gone, and the price of fuel is relatively cheap. We think that they can probably continue to grow earnings as long as oil is below $100. And so the airline business really has four players now, and we like American Airlines is one of our top holdings.
Can I like Brendon? Let me interrupt you here for a second because
Sure.
I wrote an article and I thought about this for a long time before I did it, and just the way the whole U.S. Air American Airlines went down. And they declared for the bankruptcy. It goes to the pink sheets. What, it goes under a penny, trades at a penny, and then all of a sudden it has this massive run up close to $11. So you had people that are just writing this off as a worthless investment, and then the merger with U.S. Airlines is pulled off, and then now the stock. I mean, I know American Airlines was $100 and some stock back in the 90s or whatnot. But
Sure.
to me, I mean, you're down in Dallas there. That's where they're headquartered, or we're headquartered, correct? To me,
Correct.
I mean, did you get? I mean, if you sounds like you've been investing in these issues for a long time, did you get caught in that AMR? How did you play it? AAMRQ, and were you able to? I mean, because that was a tough call to make when that thing was trading there at a penny.
Yeah, I wish we did bought it at a penny. That would have been great. But we played it from the U.S. Air standpoint, and so we really didn't buy American, and it probably wouldn't have been great for us to buy a bankrupt company in our mutual funds. But we just don't have expertise in that area, so we played the airline market through U.S. Air and Delta and United Airlines, and now we own American Airlines shares through that U.S. Air merger.
I mean, are there grumblings in Dallas? I mean, a lot of people's pensions got wiped out. I mean, people, been working there for several years. I mean, a lot of bad things happen, and do people just they put it behind them and they're glad that it was merged with U.S. Air, or is it just something that just people say, okay, it happened and time to move on?
I don't know the answer to that, but from what I hear is the really the merger and the pension plans and the salaries and the rankings of pilots and the rankings of flight attendants is not going to happen really until 15. And so we may not hear all of the grumbling until really the dust settles next year.
Okay, all right. Because I know shareholders from American Airlines that held on are still getting bits and pieces of shares of the new stock. So there is some compensation going on. So okay, now going to we talked about some of the stuff that you like. What about some of the stuff that you don't like? What are some of your least favorite sectors that you're staying away from?
Yeah. Okay. So we tend to stay away from really high multiple names that are in industries that have no barriers to entry. So we tend to stay away from those high-flying tech names just because it seems like a lot of those names can be replicated fairly easily. We also try to stay away from some of the healthcare names that are more binary. So if they have a drug and maybe they're only one drug or two drugs and they're in some sort of test phase that we don't know if they're going to succeed or not, so it's more of a 50-50 chance. We tend to stay away from those because we have no bottom side protection. So really, for your listeners, try and find businesses that have high barriers to entry that can exhibit some sort of pricing power and can continue to grow their earnings and cash flow from there.
Okay, so do you have some of your stocks in your portfolio now that maybe perhaps you're looking to take profits in? I mean, do you have profit objectives, or do you just move your stops up, or do you just wait for the fundamentals to change?
Yeah, we wait for the fundamentals to change, and there's some names that have taken some pretty good runs recently, and then we'll take profits in them. But there's always opportunity in the small cap space. So the second we have fundamentals change in one of our names, we're able to go and find something that trades at a reasonable multiple that we have a lot of interest in. So what's great about ETFs and high-frequency trading and really the small cap space in general is that there's never an end to great ideas.
Do you have some of those great ideas in small caps maybe that our listeners should be taking a look at?
Yeah, sure. So there's a company called Eagle Materials. Can you hear me, by the way?
Yeah, if you could go a little bit louder, it would be great.
Okay, perfect. There's a company called Eagle Materials in Dallas, Texas as well. It's a spinoff from the old Syntex Homes, and they really are in three different businesses. The first one is the wallboard business, and as we've seen the Chinese wallboard leave the market and we've seen new builds pick up considerably, there's pricing power in the wallboard market. We've also seen that their cement business is top-notch. They're much better managed than Texas Industries. And the cement business there's some barriers to entry by geography. You can't really ship cement further than about 100 miles due to cost. And so we think that they can earn about $8 a share from those two businesses. The stock's trading around $87, so that's a little over 10 times earnings, which is reasonable in our mind. But they've also lucked into the frac sand business. So they own some land in Illinois where they can mine frac sand, put it on a barge, let it dry as it heads to Corpus Christi, and they believe that they'll be the low-cost provider in the frac sand business.
What the frac pan you said?
Frac sand.
Oh, sand. Okay.
Sand business. Yes. And if you hear anything from the oil and gas service providers, the more frac sand you use in your drilling your wells, the better the wells produce.
Okay. All right.
So we think that's a great buy.
Okay. And what else do you like out there?
So I heard last week on the show somebody mention Hercules Offshore. We're a big fan of Hercules. They're a great example of where perception doesn't really meet reality. And so the street thinks that there are just too many rigs being supplied to the market. All jackups are spoken for really in 2014. So the supply is meeting the demand now, and then there's 63 new rigs in 15. But we really think that Hercules will, as the deepwater drilling picks up, they should benefit considerably. We think they'll do about 54 cents this year, which is 8 times earnings at their stock price of $4.50, and then about 66 cents next year. So that's a reasonably cheap name that your listeners could go take a look at?
I think that was maybe Tim Melvin, the deep value investor. Do you that maybe mention that because he's the one that likes to look at these stocks that have trading close to book value and have a good potential for earnings. So I think that was the one with Tim, and then also Trinity Industries. Is that something that's on your radar?
Yeah, we still own Trinity Industries. It's a great name. It's grown considerably outside the small cap space, but they've benefited from the oil by rail boom, and the oil pipeline business, while it's expanding, is not keeping up with demand. And so the rail car business, which Trinity is in, both the leasing and the sales side, will continue to pick up, and we think they're in a great position to take advantage of that.
So when you're trading these issues, are you kind of like just all in at one price, or do you just try and stagger your orders and get in, work out a position over a week or two, and then same on the exits?
It really depends on the name. We will really rarely buy in all at one time, but we will definitely buy in slowly. And you said weeks. It could take us months to get our full position. And usually on the sell, it's probably a little quicker because we've seen some sort of fundamental change in our thesis.
So you're trading a lot of these small caps. Is there many options on these stocks, or options part of your investment strategy?
We do very little options trading. We really like just to own the underlying business. But if there's a name that's highly priced and we're maybe low on funds in our mutual funds, we may play a name that we really like through the options market.
Yeah, if there's the liquidity there, especially for the size positions you have. Do you guys short anything over there?
Rarely, very, very rarely. And I think it takes a special mindset to short a name. You really have to be uniquely gifted, and I think that our guys are really, really gifted, but only on the long side. So we tend to stay away from shorting names.
Okay, so you'll just, if you're worried about the market, you'll just go to, a much lower cash position. Then you won't try and hedge your positions with options or futures or anything like that.
No, we won't. The way that if we like right now, we're cautiously optimistic about the market, and so instead of trying to hedge names with short names or really go to cash, we'll more spread out our names. So instead of having a concentrated portfolio of 50 stocks, which we may at the bottom of a market, we'll head towards an 80 name portfolio to diversify and really spread our risk.
So the market's had an incredible run here since the lows in 2009, just creeping up. A weak GDP number really didn't rattle the market here. Had a little bit of a sell-off that we bounced back. I mean, what could derail this bull market?
Really the answer is earnings, right? And
Okay.
if companies hiccup significantly, then we're going to see some sort of pullback. But I think that the equity market as a whole is still significantly underowned. We've seen $500 billion since 2008 flow out of equity markets and into bond markets. And you'd see even in the past week, we had about $2 billion flow out. And so it's not that there's definitely no euphoria in the market. We're not seeing any type of really over ownership and glee. It's a lot of skepticism. So I think that there's probably still some room to run, but we're cautiously optimistic and would be encouraged if we saw some sort of small pullback where we could take advantage.
Okay, and being down there in Dallas and oil land here, I mean, crude has been awful quiet. Really been in the trading range for quite some time. Some of the oil stocks have been picking up, and that you did mention the Hercules. Are there any other small cap oil issues that you follow?
There's a company called Matador Resources. The management team has had 3 different iterations of Matador since the beginning of their career, and they're a top-notch management team. They've come out and issued more shares to go and buy or more land and then hire another rig, and they operate in the Permian Basin. And we have a lot of confidence in that management team. They've shown an incredible track record of finding great areas and exploiting them. So they're small enough to be nimble, to buy and sell areas that they think are hotter than others. And if we see them go out and issue shares, that's an encouraging thing for us to see.
Okay, so just from how you're talking, I mean, you stay away from the the Twitters and the Facebooks, LinkedIn, Teslas, Netflix. I mean, those stocks are just so far off your radar. Those momentum stocks. You're looking at small caps. You're looking at value. You're looking at balance sheets. You're looking at management. Do you go and have meetings with the companies and see where the management is going?
Yes, so that's a big part of our research process. We met with over 700 companies and had 2,200 contacts with management last year alone. And so we really value what the management teams are saying. You can find a lot of new ideas by asking about their competition or about their suppliers. But you have to have some sort of skeptical view of what they're saying because they want you to buy their stock. And so you go out, you talk to the management team, and then you really verify that information with the people that they work with their suppliers and their vendors and their customers. And if they verify what you're hearing, then it over a long period of time, you can tell whether their body, their tone of voice changes, and you can really understand what's going on at the business that they run.
Okay, so just any final tips for investors here?
Yeah, just stay focused on the fundamentals. And I think if anything's encouraging, we at Hodges Capital think that the small cap space and the mid cap space is ripe for finding great ideas because of high frequency trading and ETFs. And so there's been a lot of bad press about the market being rigged or about the market being efficient, and we just continue to find great ideas and take advantage of those. So I think that'd be an encouragement to your listeners.
If you can't beat them, join them. Brendon Marks, marketing spokesperson for Hodges Capital Management, talking about small and mid-cap companies. Brendon, thanks a lot for taking the time out in your day to be on, and we certainly hope to have you on again.
Absolutely. Thank you very much.
Okay. Brendon Marks.